Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of money, and today we're diving into BlackRock floating rate income strategies, fund's latest SEC filing, and let me tell you, there's a lot to unpack in this financial prospectus. Alright, so imagine you are looking to invest in something that promises high current income with some capital preservation, and it's all about floating rate debt. This is the document that lays it all out for prospective investors. BlackRock is known for its massive scale, and this fund seems to be playing in a space that can be quite sensitive to interest rate changes. They're talking about offering up to 18 million shares of common stock, and they might also offer subscription rights, which is like a coupon for existing shareholders to buy more shares. Their main goal here is income, and they plan to achieve it by investing in a portfolio of floating rate debt, and they are not shy about using leverage, which means borrowing money to amplify potential returns. But this also amplifies risk, folks. Now, let's talk about expenses. We see here a breakdown of fees. The management fees are at 0.98%, other expenses add another 1.97%, and interest expense due to leverage is a significant 1.88%. This brings the total annual operating expenses to nearly 3%. That is a chunky expense ratio, especially when you consider the fund's investment objective. After fee waivers and reimbursements, the total annual operating expenses remain at 2.97%. It's important to note that these fees are calculated as a percentage of net assets, and when the fund uses leverage, the expenses stated as a percentage of net assets attributable to common stock are greater than they would be if stated as a percentage of managed assets. This means as a common shareholder, you are bearing the brunt of those leverage costs. Let's look at some historical performance. For the 6 months ended the 30th of June 2025, the net asset value, or NAV, per S-Share started at $12.89 and ended at $12.46. That is a slight decrease. During that same period, they reported a net realized and unrealized gain of negative $0.15 per S-Share. So while the net investment income was positive at $0.46 per S-Share, the investment operations as a whole resulted in a decrease in NAV. The total return based on net asset value for the 6 months ended the 30th of June 2025 was 2.52%. However, the total return based on market price was much lower at 1.35%. This difference highlights how the market price of closed-end funds can deviate from their underlying value. As of the 30th of June 2025, their borrowings outstanding were $134,000, which is $134 million. This leverage is a significant part of their strategy. Managed assets were $440,992,000, so that is $440.9 million. Their borrowings represent about 22.83% of their managed assets, as mentioned in the prospectus. Digging a bit deeper into the fund's structure, they are authorized to issue 200 million shares of common stock. That is a lot of potential shares, which gives them flexibility for future offerings. Now, let's look at how the market has been treating these shares. For the quarter ended the 30th of September 2025, the high market price per common share was $13.3 and the low was $13.17. The net asset value on this date was $12.46. This means the shares have been trading at a premium to NAV for most of this period, which is good for shareholders. Discount on date of market price high 5.81%, for example. On the 30th of September 2025, the market price was at a 5.81% premium to NAV. That is a positive sign. However, things can change. And looking at the quarter ended the 30th of June 2025, we see a different story. The market price was at a discount of 7.31% to NAV. This fluctuation is typical for closed-end funds and is something investors need to be aware of. Their investment objective is clear: high current income from floating rate debt with some capital preservation. They are actively managing this portfolio, and as we've noted, using leverage is a key part of their strategy to boost that income. Now, let's talk about risks, and there are many. The use of credit derivatives is highlighted as a complex activity. If their forecasts about default risks or market spreads are wrong, it could hurt performance. Even if they are right, there is a risk that the derivative might not perfectly track the asset it is supposed to protect. Another big one is counterparty risk, especially with over-the-counter or OTC derivatives. This is the risk that the other party in a derivative contract won't fulfill their end of the deal, which can happen if they go bankrupt. They try to minimize this by only dealing with creditworthy entities, but it's still a risk. And then there is the broader market stuff, geopolitical risks, like the ongoing tensions and conflicts around the world, trade wars, sudden interest rate changes, and even cybersecurity threats, can all impact the value of their investments. They mention the Ukraine conflict and US-China trade relations specifically. showing awareness of these global factors. As for the management of the fund, it is handled by BlackRock Advisors, LLC as the advisor, and BlackRock International Limited as the sub-advisor. They receive a fee of 0.75% of managed assets plus leverage proceeds. Looking at expenses again, if you are buying shares directly, there might be a sales load paid by you. And for those reinvesting dividends, there are small fees, but they do add up. In this financial highlights table, we see ratios to average net assets for the 6 months ended the 30th of June 2025. Total expenses after waivers were 2.66%. For the full fiscal year 2024, it was 2.95%. This shows their ongoing costs to manage the fund. Looking at the net asset value per S-share over the years, it has been fluctuating. It was $13.81 at the end of 2020, went up to $14.55 at the end of 2022, and is now $12.46 as of the 30th of June 2025. It is not a smooth upward trend, which is typical for actively managed debt funds, especially those using leverage. The portfolio turnover rate is interesting. For the 6 months ended the 30th of June 2025, it was 18%. For the full year 2024, it was 36%. This suggests they are not aggressively trading, which can be good for managing transaction costs. But it also means they are not rapidly shifting their strategy if market conditions change drastically without explanation. They also detail a potential rights offering. This can lead to dilution for shareholders who don't exercise their rights. And if the subscription price is below NAV, it can immediately reduce the value per S-share for everyone. This is a common way for closed-end funds to raise more capital, but it can be tricky for existing shareholders. The filing really emphasizes dilution as a key risk with rights offerings and new share issuances. They state that if the subscription price is less than NAV, shareholders will experience an immediate dilution. This is a crucial point for anyone considering participating in such an offering. The investment management agreement lays out how the advisor gets paid. It is 0.75% of managed assets plus leverage proceeds. This means the more leverage they use, the higher their fee. It's a pretty standard structure, but highlights how leverage directly impacts management costs. Now, let's look at how this fund and others managed by BlackRock approach voting their proxies. They have pretty detailed guidelines. They tend to support management recommendations but will vote against directors or proposals if they have concerns about governance, executive pay, or lack of disclosure. This signals a general approach to responsible investing. When we look at BlackRock as a whole, their assets under management are massive, around $13.5 trillion. This gives them immense influence, and their stewardship policies, as laid out here, are significant in the corporate governance landscape. So, what is the story here? BlackRock Floating Rate Income Strategies Fund aims for high current income using leverage and floating rate debt. The expense ratio is on the higher side, and the use of leverage magnifies both potential gains and risks. The fund's NAV and market price can be quite volatile, and they have strategies to manage risks. But those strategies come with their own set of complex risks like derivatives and counterparty exposure. The potential for rights offerings adds another layer of consideration for shareholders, particularly regarding dilution. Their proxy voting guidelines show a commitment to good governance, but it is crucial to remember that management fees directly correlate with their use of leverage. Overall, this fund seems geared towards investors comfortable with a higher risk profile in exchange for potentially higher income, and who understand the intricacies of leverage and derivative instruments. The complexity of the risks outlined, from credit derivatives to geopolitical events, is substantial. What is your take on this filing? Do the potential returns outweigh the listed risks? Let us know in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more corporate deep dives. And don't forget to join our Discord community for more discussions. Thanks for watching, and we will see you next time on Corporate Decoder.